Burton Malkiel's A Random Walk Down Wall Street is one of the most influential books on investing, offering readers a comprehensive guide to understanding the stock market and making sound financial decisions. First released in the early 1970s, the book has been updated several times, continuing to shape investment strategies and offering timeless advice for investors of all levels. The concept of a random walk. The central idea of a random walk down Wall Street revolves around the concept of the random walk. Malkiel proposes that stock prices are inherently unpredictable and that their movements follow a pattern that cannot be reliably forecast. This is grounded in the efficient market hypothesis, EMH, which asserts that all known information about a company or asset is already reflected in its price. Therefore, Malkiel argues that it's impossible for any investor to consistently beat the market by predicting price movements, analyzing financial reports, or using technical methods. In simple terms, the stock market behaves like a random walk, where price changes appear to be driven by chance rather than rational prediction. Malkiel's point is that the randomness of stock prices means that even experts are unlikely to make decisions that outperform the broader market over time. Critiquing common investment strategies. Malkiel doesn't just introduce the random walk theory, he also takes a deep dive into various investment strategies that have been popular over the years, showing their limitations. 1. Speculation and bubbles. The book takes a critical look at speculative bubbles throughout history, such as the dot-com bubble in the 1990s. These are times when irrational investor optimism drives asset prices far beyond their true value, only for them to crash later. Malkiel explains how such speculation is a key contributor to market instability and cautions against chasing trends. 2. Fundamental analysis. Traditionally, investors have relied on fundamental analysis, which involves examining a company's financial health, earnings potential, and other metrics to predict its stock price movement. While useful in some cases, Malkiel argues that, in the long run, trying to identify undervalued stocks is often ineffective, as markets tend to correct themselves over time. 3. Technical analysis. Malkiel also critiques technical analysis, which uses past price patterns and trading volume data to forecast future price movements. He suggests that, like fundamental analysis, technical analysis offers no real advantage over a random strategy, as stock prices are influenced by so many variables that past patterns often offer little predictive power. 4. Active management versus passive investment. A core criticism in the book is the failure of actively managed funds to outperform the market consistently. While fund managers often claim they can pick the best stocks, Malkiel points out that most active strategies don't yield higher returns than a simple low-cost passive strategy. This is where Malkiel introduces his main investment recommendation: index funds. The case for index funds. Instead of relying on the unpredictable nature of stock picking or the timing of market movements, Malkiel advocates for passive investing through index funds. These funds track the performance of a broad market index, such as the S&P 500, and offer investors exposure to a wide range of stocks without the need to actively manage their portfolio. Malkiel emphasizes that, by investing in an index fund, investors are essentially betting on the overall growth of the economy rather than trying to pick individual winners. This approach is not only simpler, but also tends to be more cost-effective. Index funds charge lower fees than actively managed funds, meaning investors keep more of their returns over time. The book makes a compelling argument that this strategy, involving long-term, buy-and-hold investments in diversified index funds, is the most reliable way for the average investor to build wealth. Understanding behavioral biases. Malkiel also discusses how human psychology plays a crucial role in financial decision-making. Investors often make irrational choices due to biases like overconfidence, herd behavior, and loss aversion. For example, during market booms, investors may ignore caution and pile into stocks, hoping to ride the wave of optimism. Conversely, during market downturns, they may panic and sell off investments at a loss. These emotional responses can lead to suboptimal decision-making and missed opportunities for long-term growth. The book illustrates how these cognitive biases contribute to market fluctuations and bubbles, such as the irrational optimism during the dot-com boom or the fear-driven sell-offs during the 2008 financial crisis. However, Malkiel stresses that even though these behavioral tendencies cause short-term volatility, they don't provide a way to consistently predict or profit from the market's future movements. Diversification and asset allocation. A critical element of Malkiel's strategy is diversification. He argues that a well-balanced portfolio, spread across various asset classes like stocks, bonds, and real estate, can help manage risk and improve returns. By diversifying, investors can reduce the impact of individual asset volatility. For example, when stock prices are falling, bonds often perform better, and vice versa. Malkiel also discusses asset allocation, or how an investor should divide their funds across different types of investments. He emphasizes that asset allocation should be based on individual factors such as risk tolerance, investment goals, and time horizon. This method helps smooth out the highs and lows of market cycles and can lead to more consistent performance over time. The long-term perspective. Perhaps the most important takeaway from a random walk down Wall Street is the value of a long-term perspective. Malkiel advises that investors who stay invested over time, regardless of short-term market fluctuations, are more likely to see positive returns. He cites historical data showing that, while markets may experience periods of volatility, the overall trend of the stock market has been upward over the long run. Malkiel also reminds investors that time is one of their best allies. The longer you stay in the market, the more likely it is that you'll benefit from the compounding of returns. This underscores the idea that investment success comes not from trying to outguess the market, but from sticking with a disciplined, diversified strategy over the years. Conclusion: a smarter way to invest. In the end, a random walk down Wall Street is both a critique of traditional investing strategies and a call to embrace a smarter, evidence-based approach to building wealth. Malkiel's advocacy for index fund investing, proper asset allocation, and a long-term mindset provides a solid foundation for any investor who wants to avoid the pitfalls of speculation, emotional decision-making, and trying to time the market. By keeping costs low, diversifying investments, and remaining patient through market ups and downs, Malkiel shows that most investors can expect to achieve solid returns over time. His message is clear. Rather than trying to beat the market, investors should embrace the market and invest in a way that reflects the broader trends of economic growth. For anyone looking to take control of their financial future, a random walk down Wall Street offers a thoughtful, data-driven approach to navigating the complex world of investing. Whether you're new to investing or a seasoned pro, Malkiel's timeless wisdom provides valuable guidance on how to make smarter investment choices for the long haul.